2021 presented plenty of challenges for investors. A tug-of-war raged between COVID variants and vaccines. Many economies experienced their highest levels of inflation for over 30 years. And in China, the authorities launched a brutal clampdown on the country's most successful companies, whilst at the same time, the world's most indebted property developer teetered on the brink of collapse. However, despite this, most equity markets provided very healthy double-digit returns. UK equities delivered just over 17%, more than erasing 2020's decline of 10%. The US market completed a three-peat of annual double-digit returns, providing close to 28%, and the European market delivered a very healthy 18%. The emerging and Asian markets, however, ended the year down. This was due to China selling off and many Asian countries either still being in shutdown mode or having very low vaccine rollouts. In the bond markets, for the first time in a long time, investors in UK government bonds, or gilts, lost money over the course of the year. The broad market gilt index closed the year down approximately 5%, although it was down close to 9% partway through the year, in what was a very volatile year for gilts. This overall lift in gilt yields also impacted the UK credit markets, but to a lesser extent as they fell by approximately 1.5%. Despite equity markets providing a bumper series of returns in 2021, it was actually a difficult Q4 for active managers, particularly within the US and the UK. For the US, this was down to the market being led once again by a very narrow group of stocks. However, this time it was down to an eclectic mix of the vaccine maker Moderna, a technology behemoth Nvidia, and a clutch of oil companies, rather than the FANG stocks that we all got to know and love during 2020. In the UK, the challenge was slightly different. Firstly, it was down to several funds having biases towards the weaker performing small and mid-cap markets, and additionally, it was due to macro forces driving returns such as interest rates and Omicron rather than underlying fundamentals. We're fairly sanguine about the prospects for economic growth in 2022, expecting it to moderate from 2021's rebound level, but to still be solid. As always, however, there are risks, and amongst them we would cite a resurgence of the pandemic, a squeeze on consumer spending caused by higher inflation, and or maybe even an exogenous event, such as a property-related financial shock in China or military conflict. However, the big threat to continued economic growth is inflation, and particularly how central banks respond. Do nothing or too little, and the inflation genie might well and truly escape its bottle. However, excessive tightening of monetary policy could expose the high levels of debt embedded in the financial system and take the steam out of any equity market rally. For this reason, we remain neutrally positioned on equities. Against our most likely backdrop of robust economic growth and lingering inflation, we expect bond yields to trend higher in 2022. Accordingly, we will maintain our short duration bias.